Hello and welcome back to Learn It from a Layman. I am Carl Christensen, joined tonight by Tim. I'll break your kneecaps, Cox.
Well, finally, a complimentary nickname. That's
Is that a compliment?
I think so. Well,
You're the
mostly
muscle.
because I'm small of stature, so anything suggesting otherwise.
um, okay, yeah, we're going to talk about insurance, but before we do, we have to talk about the fact that I no longer have a mustache. I don't actually love having a mustache. I'm okay with a beard. I'm okay with a goatee, but a mustache, I don't know. There's something about it. It
I
just
think
makes
it's
me feel.
because you have no memory of the 80s. Magnum PI.
It just makes me feel dirty, like I've done something wrong and it's like living.
We just
But
lost 1/8 of our viewership, all the mustachioed men.
but we've gained actually a larger percentage of the population who agree.
Boy, craven pandering by mustache bashing. That's just.
Well, I do have to put the caveat that my wife likes mustaches, and so that's
Good
thus
job,
the reason I ever had a mustache. Okay, mustaches, though, unrelated to tonight's topic, which is the basics of insurance. And candidly, so we're again a day late releasing a podcast, which somehow again is Tim's fault. But in a real way, I didn't record this podcast earlier because we have a couple podcasts in the pipeline about ones that have been requested. Chemistry has been requested for a while, and a variety of other engineering topics. But I wanted to come up with something that I was passionate about, that I wanted to talk about. And it probably says some, relatively unflattering things about myself, that I'm actually passionate about insurance. But it's only
Yeah.
because I'm not an actuary. It's not a thing that I do. But
most of us don't even know what an actuary is.
yes, an actuary is a professional number cruncher / insurance nerd, I think is their official title. Right, Tim?
Yes, I'll vouch for that answer. All of my actuary friends will agree.
Because you'll make them. Because that is one group of people that you can bully, Tim.
Whatever, they're growing mustaches and becoming much tougher. Actually, actuaries probably go in the class of people who don't care if you call them a nerd because they know how much more money than you they're making.
That's true. And they know how to analyze the risk that you pose, and they know that Tim and I pose very little risk to their personal well-being.
Not until we grow better mustaches
and
start wearing
yourself,
Hawaiian shirts.
I had an awesome mustache.
I will vouch for that as well.
I had to shave it for my Halloween costume. It was for a good purpose.
Oh, what kind of a costume would you wear that requires you to shave a what?
Oh, yeah, well, I'll have to. I think we can do is our next podcast. I can be in costume, and maybe it'll up our YouTube viewers because it is disturbing. So,
Well,
okay, let's get on to insurance here. So, we talked a little bit about actuaries. Actuaries, yeah, that's just one of the variety of insurance careers. Anecdotally, to start off a little discussion of insurance and kind of what my background is in insurance. My first coding job, so I am a software engineer by trade, but my first job in the software field was actually working for a company that that provided software to car insurance, auto insurance companies that did rate comparison. So back in the late aughts, I guess, the company I worked for coded up essentially insurance manuals, which is only slightly less interesting than it sounds.
Wow, yeah.
But it was really insightful for me. Besides the fact that I got my first a foot in the door with a coding job, I also got to learn a lot about auto insurance, which is one of the reasons I do care about kind of the health, or not just health. I care about insurance in general is because there's a lot of specifics, and I think the layman knows some of them, but is generally just aware that insurance is a large percentage of the money that you spend monthly out of your paycheck. And so the more that you can refine your knowledge about insurance, the better that your chance you're going to have of lowering that insurance premium and or upping your insurance effective effectiveness, efficiency.
Efficacy.
Okay, whatever, Tim. Don't I do not appreciate that type of crude language. Okay, let's start with some auto insurance here. So we're going to talk about coverages first here. So before we talk about policy, costs and all those other things, let's talk about the actual thing that you're paying for, and that's in coverage, right? When you're paying for an insurance, you're giving money to a company that is promising you coverage over something. You're insured in some way, meaning they're going to take the risk of some possession of yours or of your life. And so auto insurance is the coverages that obviously deal with your automobiles, with your cars. So there's a liability insurance, and in liability, there's a couple different types of coverages there as well. There's your bodily injury insurance. So liability is the most important variety. Before I go into specifically what liability insurance covers, liability is the one that for the layman out there, that's the one you really have to care about.
Is that the one you're legally required to have in the United States, at least?
That's correct. Yes. So there are usually state limits, meaning you have to have a certain amount of coverage legally in order to operate a vehicle. So,
okay.
And whoever offers, whatever companies offer auto insurance in your state will know those state minimums, and you can't buy a policy for less than the state minimum inside your state. So you don't have to worry about that, but you do have to worry about the fact that what most laymen don't know is that if you buy the cheapest auto insurance and you're paying for, let's say, I think the state minimum in California, it's pretty low. It's something like $15,000, $30,000, which means like a $15,000 per person bodily injury limit and a $30,000 per incident limit, meaning if there's 2 or 3 or 5 people in the vehicle that you hit, your insurance caps out at that $30,000 limit, and for an individual, if there's just one person, it'll cap out at $15,000. If that is what you're paying for, and you get in a very bad at-fault accident where the individual that you have hit has severe injuries, your insurance is done at that number. They're not legally required to pay anymore, but you are. You are legally on the hook for whatever is over that. Now, here is the comfort I can give the layman out there is most of us aren't worth a whole heck of a lot of money, and so it's not worth going after us.
I think if I'm injured by someone else in a car accident, I have to give them money.
Yeah, pretty much. That's how that works, Tim. No, in very few cases, if Jeff Bezos just absolutely smashes your vehicle and you're in the hospital for a month, and he has state minimum car insurance,
which surely he does.
Well, no, I mean like only state minimum. Yes. He has at least state minimum, Tim. But yes, let's say he's actually a tightwad. He's super cheap, and he pays you $15,000, and your medical bills are $100,000. It is absolutely worth your time to get a lawyer and get the rest of your hospital stay covered. However, if I got hit by Tim, which is incredibly likely, I mean, I don't know how I haven't been yet.
I keep trying, but you're good at dodging.
The likelihood that I'm going to go after Tim, besides the fact that we're family, and that would seem a bit,
Yeah.
wrong.
Come on, Carl. Even talking about it is offensive.
Tim, while he, is managing his money quite well, he's not Jeff Bezos yet. And so me going after him is probably not going to, I mean, between the lawyer fees and the court dates and all that other junk, how much am I really going to get covered? So your coverage limit, I mean, certainly take it serious because people can go after you. And if you don't have the insurance coverage necessary, then, and you have large equity in your home, guess what? They can go after that. So be aware that you probably want to do more than the state minimum if you're not in your 20s. If you're out of your 20s and hopefully in a good job and building up your personal wealth, go higher. Anyway, that just word of wisdom. So that's bodily injury. So that's that coverage that covers the injuries of the people in the vehicle that you hit. There's also, of course, property damage, property liability. So obviously, if I mash into, say, Tim, like was it a Lexus?
Yeah, no, it was a thing of Ford Taurus, or was it a Lexus? I don't know. It's something. It's more expensive than it should have been.
It was significantly less expensive after you mashed into it.
That's right.
If you hit a valuable car, you could be on the hook for that property damage. Once again, depending on how much coverage you have in your policy. So that's the other liability part.
And by the way, speaking of wisdom, just as a heads up, if you are ever going to get into an accident, it will be with an expensive car. That's a rule I've discovered. It's just how things work.
Yeah, well, Tim is likely to get in lots of accidents, and therefore
there's a reason
chances...
Carl got me on this podcast. I'm actually an expert on.
Tim can tell you where to hit the car, the optimal speed at which to hit it.
That's right. So, how to get different kinds of crumple effects on the exterior. Yeah.
Candidly, Tim, you should be working for an insurance company at this. I mean, you have so much anecdotal information.
Kind of like that Catch Me If You Can guy went to work for the FBI.
Exactly.
Yeah.
And I think they probably also would need to get Leonardo DiCaprio to play you.
He would probably be the right guy.
It seems like, just looks wise.
Well, if they caught him 20 years ago when he was still young and lithe, as I am now.
Okay. All right. So property damage. Okay, that's liability insurance. There is also kind of a straddling the comprehensive and collision, which are your non-liability coverages. The other kind of straddles the divide here is the uninsured or underinsured motorist coverage, which is the idea that if I get mashed into by, say, Tim, once again, and I'm in... Who else? Yeah, exactly. The vast majority of our listeners can consider it a real possibility that sometime in their life they will be hit by Tim.
It's actually considered an honor in many cultures.
Okay. Underinsured. So Tim, of course, does follow the law, keeps the law. So he has insurance, but of course he's also a infamous tightwad. So he has the state minimum coverages. And so I'm in the hospital for a month, and I come out and I have my $200,000 medical bill, and Tim's insurance company gives me the $15,000 that I'm owed by them, and Tim has fled the country with his nickel, and I have no recourse. So what I can do is my underinsured motorist coverage of my own auto policy will cover some amount of that medical bill, right? Once again, depending on the coverage. So look at that number as well. It's obviously significantly less likely because legally everyone's required to have insurance and hopefully sufficient insurance to cover your bills, but it is something to be aware of. Medical payments, in the case that you have health insurance or your health insurance doesn't cover whatever issue you have. Comprehensive and collision then are your coverages that cover your own vehicle, in the case of an accident, in an at-fault accident. So when Tim mashed into whatever vehicle that was, the other insurance, the car that you hit, they don't have any liability. They don't have to pay a dime, right? But here Tim has now mashed our Grand Prix, and we need a functioning car. Therefore, we need our insurance to cover the price to get the car fixed up again, and that is your that's your collision coverage. And those are usually priced with a deductible. A deductible is going to be a common term in tonight's podcast. Deductibles, of course, the idea that before the insurance pays, you have a certain amount of money that you have to pay. So you have your policy premium, which is the amount of money that you have to pay monthly in order to maintain, or every 6 months, or whatever it might be, annually, in order to maintain that insurance coverage. But the deductible is the amount of money that you have to pay out of pocket before your insurance will cover a claim. So usually, go ahead, Tim.
Oh, I was going to talk about like the reason for the deductible, because if you've ever had to use insurance for anything, then you've probably thrown your hands up in frustration and said, what on earth? I pay them, to cover this, so why am I still paying afterwards? And as I understand, and Carl, since you've worked in the biz, maybe you can verify or clarify, the purpose of the deductible is kind of, it helps the insurance to filter out frivolous claims, or from getting nickeled and dimed by people, right? So they say, we're here to cover your dire problems, but if you're going to try to cash in on us every time you got a little scratch on your car, well, this deductible is going to basically protect us from that, and you're only gonna cash in on our services if you really need our help. Am I understanding it right?
Correct. Yeah. And it's essentially, it's just a technique, a method to do risk management for the company, for the insurance company, right? The idea, like you said, if there's a deductible, then their risk is whatever the likelihood is that you get in an accident or anything contacts your car. That is the risk of having to make a payment. If there is suddenly a deductible, a host of other factors come into play. Like you said, it's not just does the damage rise to this level, but does the person that wants to file that claim think it's worth their while? Do they think there's a bunch of other things? So their risk, takes a big hit, and then obviously as the deductible goes up and up and up, their the insurance risk goes down further and further. So yeah, it's just a way for them to manage their risk. And yeah, they don't want people, a bunch of frivolous claims, or if they do, if they're taking that risk on, they want you paying out of the nose, because they're going to be covering a lot of things. So.
And just to clarify, this is a nose with lots of money in
it. Wait, whose nose doesn't have a lot of money?
Ask Lloyd's of London, which I learned the other day is not an insurance company.
Okay, well, I don't know what it is, so.
You don't know Lloyd's of London? They're the ones that they would they're famous for insuring, Greta Garbo's legs, or some pianist hands, or
okay,
and that kind of thing.
Nice.
Fred Astaire's feet, or probably legs, actually. But I don't know.
Nice. Yeah. Okay. Well, I learned something from Tim, no less.
That's right.
Okay. So we're getting stuck here on auto insurance. I got to move on. So collision, comprehensive. Comprehensive is for anything that could happen to your car that is not collision related, right? Like a moose runs into it, a tree falls on it, a kid, you parked it on the street and the kid ran his bike into it. Some of the things that comprehensive policy might cover. So those are optional coverages. If you we'll come back to how to manage those types of things. And then there's rental reimbursement, roadside assistance, those types of coverages that you can pay for as well. So those are some of the basic coverages of car insurance or auto insurance. And we're going to come back and talk a little bit more about how to manage it. I already talked a little bit about the how to manage your liability insurance, but we'll talk a little bit more about that and after I cover the other coverages. We're going to talk about health insurance, life insurance, and home insurance. So let's buckle up. It's going to get exciting. Health insurance. Tim, do you have health insurance?
I do.
All right. But if you, for example, have children in a hospital that is not in network, do you have health insurance?
Should I tell my story?
I think so.
Okay. Well, yeah. So health insurance is fun. So Carl's talking about these things like in network. So how health insurance works, or at least part of it, is these insurance companies will, like, I don't know exactly how it works, but they'll bargain with different providers and things for deals and stuff. And they've got the power of all of these clients that they work to cover. And so they can kind of use that to get good deals. And then, so if you're one of those health insurance clients, then you have to use one of the providers that the insurance company has bargained with and has in their network. And if you do, they'll cover you. But if they don't, then you're on your own. And so, the price differences can be pretty striking. So, for example, my wife was having twins. They were born premature, and so we're zipping to the hospital where my wife is insured in network, and they deliver the babies and get them taken care of, and as far as premature babies go, things went pretty well, and we're very grateful. So they get them into the NICU, and they've got them all taken care of, and we're good to go. So they were there for a month, and it was a very unusual time, but they were well cared for, and they did well, and after a month we were able to bring them home, and that was a very happy time. So but then fast forward months later, and we start getting these eye-popping bills. As it turns out, while my wife and her labor and delivery were covered in network, which is why we went to that hospital, our daughters, who we had on a different insurance, were not, and we hadn't really had much experience with NICUs and stuff like that. So their labor and delivery was covered, but their NICU stay was not. So it turns out that a month stay in the NICU times 2 ends up being a lot of money.
And that's what actually the bill said, right? It didn't just say a lot of money.
Yeah, that's right. It said more than you got. It said take your mortgage and multiply it by 3, and that's how much money you owe. And so it was a real eye-popping amount, and it took us a couple of years, I think, before we finally got things worked out. But we're okay, and things are good. But it can be kind of a harrowing, unfamiliar experience working through all of the ins and outs of insurance and not exactly knowing what's going on until after the fact, and lots of calls on hold. Anyways, so the bottom line is caveat emptor. Let the insured beware.
Nice. I'm sure at this point our international listeners are chuckling themselves about the whole universal health insurance of thinking that they've never had to deal with such an issue. Those in the United States, though, we have to deal with this on the reg. So
it really is a hot mess. And I'm sure there are challenges with healthcare systems anywhere around the world. Yeah. But yeah, it is frustrating sometimes, many times.
Yeah. So, right. And this isn't and has never been and never will be a debate podcast. Wait, should it be a debate podcast?
I will disagree with whatever you say, just to.
But yeah, there are various types of health insurance in the United States. We don't have universal health care, so it is important for those of us that live in the United States to be familiar with our health insurance and to have health insurance, because when you are in severe pain and or dying, the likelihood that you just stay at home, well, first of all, you shouldn't. I mean, go to the hospital, go get taken care of, or
Yes.
whatever you need to do. But make sure that you're insured first, because otherwise you could be in for large and unexpected bills. So,
but if you're not insured, still get to the hospital. Dying is a suboptimal outcome.
Yes, there are lots of charities. There are lots of organizations in the United States that do help, that make bills disappear. And I'm not talking about the mafia.
You want to make that bill disappear? I got a friend.
Okay, let's hit a couple terms about health insurance before we move on, though. So there's the traditional HMO and PPO. So your HMO is sorry, I had the term looked up here. Let me see if I can find it. It is your health.
Terrible term, by the way. Sorry, I just hate HMO and PPO. It just makes my skin crawl, even just talking about it.
Yeah. Well, it's worth knowing about, though, Tim, so that we don't have children out of network.
Yeah, that's true. Just like you should know about bed bugs.
Health Maintenance Organization. That's what HMO stands for. And that general, that's insurance where you have a primary care physician, and they're kind of the gatekeeper. You kind of have to go through them to get authorization for services that are not emergency services that you need. So if you need to go see a specialist somewhere, meaning anything that is not your either pediatrician or, like I said, primary care physician, you need to go via your primary care physician, get a referral, and move on to the specialist. Having that gatekeeper saves this organization lots of money, because once again, you don't get people frivolously bopping into a variety of doctors who they think they want or need services from, when in reality the primary care physician would say, oh, actually that's not what you need, or this isn't the time to do it, or whatever it might be. That gatekeeping mechanism helps them save, and which then helps HMO plans be generally a little cheaper than their alternative or ubiquitous alternative, the PPO, the preferred provider organization. And your preferred provider is more of a network of facilities, kind of what Tim was talking about before, where this organization has gone through and kind of established some rates with facilities and doctors. But you don't have to choose a primary care physician per se. I mean, most people will, but in order to go see a specialist, you don't have to go via your primary care physician. You can just call up that doctor's office and make the appointment. Yeah, so the other types of healthcare plans are your point of service, or POS, I guess. Not that type of POS. And an exclusive provider organization, or EPO, both of which I know almost nothing about, so I won't comment on. But there are other varieties of health insurance in the United States. Like I said, generally, in a lot of other Western countries that listen to us, you have universal health care, which means you're covered as in the country. You go to a doctor and you're going to have coverage. The downside usually is a longer wait, but the upside is you have coverage. So that is health insurance. We'll come talk about that a little bit more. But oh yeah, a couple other ideas before we move on to that is, for the specialized services, some health insurances don't cover a variety of things you might want. And so you might want additional coverage that you go out and pay for another policy. If you have fertility issues, cosmetic surgery, hearing aids, long-term care, any of those types of things are often excluded in your basic health insurance. And so these are market policies that you can find out there. They're just going to be more expensive. And so you can go shop it around if you want, or you can just go get quotes from doctors for those services. Tim, any insights into health insurance?
I'll throw out just one thing. There's something, it's not actually insurance. It's called a health share. And I actually use this. So a health share, it's kind of like Um, so you pay into it kind of like a health insurance, but it's not technically health insurance. It's just when you do anything with health or anything that would be covered, you pay for it out of pocket, and then you apply for it to be covered by the health share. So it's kind of like a credit union is to a bank kind of thing. It's technically a credit union technically isn't a bank. It's just a bunch of people, pooled their money together, and that's kind of what a health share is. So I've got limited experience with it, so I'm not going to say go out and do a health share, but they tend to be a bit cheaper, but they're also more selective. Like if you've got like let's say you're a smoker or something, you're probably not gonna they're not gonna let you enroll and things like that. But if you're young and relatively healthy and say don't have a lot of money and maybe are in a situation where don't have health care right now, or health insurance, I should say. If you don't have a lot of options, that might be something to look into. That's kind of a better than nothing. And I actually, when I switched from one school district to another, there was actually a 2 or 3 month gap where my health insurance lapsed on from my old job and hadn't started up for my new job, and so I actually signed up for a health share for a few months just so I would have, coverage in case of it. It doesn't give you a lot of the perks and bells and whistles that a standard health insurance would. It's mostly like cover you in dire circumstances or cataclysmic events, but it's just a little peace of mind. So if you don't have health insurance, get something, and if regular health insurance is too expensive, maybe you can at least get some kind of peace of mind with a health share. So just another option. Again, this is not a recommendation. I used it for 3 months, and nothing happened. I didn't have to use it, but it just gave me a little peace of mind that I had something in case of a real bad situation. Anyways, bye.
Right. Yeah, that's good information. There's, uh, as of, I don't know, it's been more than a decade ago, health insurance in the United States is it still required? I forget what state the law is in actually, but it
Yeah.
was once it required.
Hmm.
Do you remember? I don't remember.
Yeah, you'd get
Anyway,
like a ding if a fee if you didn't, right?
yeah, I just don't remember if the law changed since the other. I don't know. Anyway, so again, it's a good idea to have health insurance, and I know the state exchanges still exist, and you can get tax subsidized help with health insurance. So if
It,
it just sounds too expensive, I mean, the government does have an interest in you getting covered so that hospitals aren't on the hook for providing services to uninsured people.
and take that seriously because you don't have to be like dirt poor to qualify for a government subsidized health insurance. So there's a lot of people qualify, and I think probably more than are taking advantage of it. So
Right. So regardless of how you feel about that, about the law, the reality is that it's where we are, and it's a good idea to get coverage. And if you want to go out there on a personal market and find your own, and you have the money to do so, great. But if you don't, use that to your advantage. All right, life insurance, everyone's favorite insurance,
uh,
the insurance that you will never use. Maybe
we
your
hope.
loved ones
Yeah.
will.
Yeah, that's
Your
right.
loved
Your
ones might
family
use it,
will.
but you will not use this insurance. um, and so that is, here's what I highly recommend. There's a variety. We're going to talk about the basic types of life insurance, but the term insurance is the one I highly recommend. And the whole idea behind term life insurance is you're buying life insurance for a specified period or term, and meaning I'm buying it for a year. I'm buying it for 5 years. I'm buying it for 10 years. I'm buying it for 20 years. And I can get a fixed rate for the period of time that I'm paying a certain amount monthly for a death benefit of a particular value.
Just to make sure everyone's clear, life insurance, it means if you die, then your spouse or whoever your beneficiary is gets paid a bunch of money, basically the replacement. So in my case, I have life insurance so that if I die, my wife and kids who are suddenly without my income will have enough to get by and for example take care of if we have a mortgage, they won't get kicked out of the house, or and they'll have their needs met. That's what life insurance is for.
Right, exactly. And we'll talk a little bit about why, when to have life insurance, when not to have life insurance here near the end of the podcast. All of these things I'm going to go through and just kind of talk through the risk association with each insurance and how it changes and when it changes and how to evaluate that for yourself. But yeah, life insurance, as lame as it is, you should have it, especially if you have dependents. If you have no dependents, I guess it's up to you. Probably get your burial expenses covered. But yeah, health insurance and life insurance very often are covered with group policies at work. So if you have a full-time job, you're going to have health insurance available to you and life insurance available to you. Usually life insurance they're going to require a not inside a group scenario. So if you buy it on the market, on the open market, you're going to need a health evaluation in order for them to assess the risk that they are taking in your policy. Because if you are 80 years old, it turns out you're significantly more likely to die in the next 5 years than the 20-year-old who also is applying for the policy. So, yeah,
wait, you're not an actuary?
No, I am, Sam. That's how I knew that.
That's right. That's why they pay you the big bucks.
Yeah, I don't know how anyone else could ever know that. So yes, the besides that, obviously, if you're diabetic, if you have a chronic cholesterol issue, high blood pressure, all these different things are going to
love to go skydiving.
Right. Those things are going to affect the risk that you pose to the company as per your the likelihood of your death. So the group policies assume a certain baseline risk across a larger group of individuals, right? My software company, it turns out very few software engineers skydive. I mean, some do, but most don't. And so, but if I worked at a skydiving shop, I'm guessing life insurance is just more expensive, even
Probably.
for a group policy. So so term life is what I recommend if you're going out in the open market, even if you, I think most, Tim, your life insurance as a teacher, is that term life as well?
Yeah. And yeah, don't get whole life. You shouldn't mix your insurance with your investments. And if
Tim,
you are,
you stole my advice.
Oh,
get off.
Yeah.
Get off the podcast. Yeah, there's whole life, there's universal and or indexed universal, there's variable. These are all different life insurance products. Whole life, the idea is the premiums are the same. You have guaranteed rate of return on the policy's cash value, and the death benefit doesn't change for your whole life. Thus, a whole life policy. Universal universal life insurance, the premiums increase, but has a cash value that decreases to pay for that increased premium, and it grows based on some type of interest rate, market-based or bond-based or something. And a variable life insurance, I think the idea is it's based on a stock fund, so it takes some management by you, and so you can get some return, but it's once again, it's a mixed product, cash value for your death benefit versus your value of an insurance product or your investment product. So like Tim said, every financial planner I've ever talked to said, don't mix these. It's unnecessary. And as we'll come back to later when I'm talking through the various types of ways you can manage these insurance products, it's just clean. There's a reason for it to be cleanly just life insurance. And we'll come back to that why, but that's why term is what I recommend. Burial insurance, apparently you can just get, and that's your basic life insurance where it just covers your death expenses, your expected death expenses. Okay, home insurance. I think we did talk a little bit about this a year or two ago when we talked about the basics of buying a home. Tim, does that sound familiar?
It does.
You have insurance on your house, Tim, right?
Yes, I do.
And you even did we make a big deal of this on the podcast? We should have. Tim paid off his house.
Yeah.
It needs to be some type of like applause sound effect. You get me. Yeah.
Yep. I'll take it. I'll take what I can get.
So even with your house paid off, Tim, do you need to have homeowner's insurance?
Absolutely. I mean, well, technically you could not, but then say your house burns to the ground, then, you're not on the hook for your mortgage, but you'd have to like set up a tent on the charred ashes of your home's remnants. And anyways, so yeah, that's a downer. I think that would be a problem.
Yeah, I don't think your wife would go for it. So
he has told me as much.
But you specifically talked about putting up a tent on the ashes of your burned down home.
I have lots of ideas, okay? They're not all good ones.
That went without saying. Yeah. So homeowners is required when you have a mortgage. The mortgage company requires you to have homeowners insurance because, once again, their risk is based on the fact that if you don't pay, they can take your home, and if your home is gone because it burned down, all of a sudden the risk calculation has now changed significantly. You have no reason to pay them back. Yeah, but beside your good word, or whatever. So anyway, so once you pay off your home, it's still highly recommended that you have home insurance because, like Tim said, it turns out your house burns down, if it floods or whatever happens to your home, you want coverage so that you don't have to pay what now in the Western United States $400,000 for a new home.
Yeah. And speaking of floods, it's always good to check and be careful. Different insurance policies may or may not cover different situations. So you'll have a storm go through an area and flood a bunch of stuff, and a lot of people discover to their chagrin that flooding is not covered in their house and home insurance. And so anyways, just pay attention, especially if you live, say, in a coastal city or a floodplain.
Right. Yeah, natural disasters are frequently not covered. And so a flood is considered as absolutely that. Earthquakes, I guess I was thinking more of a broken pipe flood, which I think is usually covered, but it is certainly worth looking into your policy to find out. So I was going to go through the variety of coverages, Tim, but did you have an insight in home insurance before I dig into a couple of specifics here?
Maybe after you give the specifics and stuff, I can share some of my personal experience and past.
So there are different. The coverages are lettered, which is kind of lame. There's coverage A, B, C, D. I mean, which is pointless. The most recent homeowners insurance that I've seen, they're starting to be less numbered coverages or lettered coverages because the layman doesn't want to see a letter. That doesn't help me. But let's say the coverage A is your home rebuilding coverage. That's your basic. My house burned down. How much insurance do I have? And so that's your coverage A, and that's going to be something close to the value of your home, right? And beware of, if you bought your home 10 years ago, the value of your home has gone up significantly, as has the cost to rebuild it. So make sure you're insured at a relatively appropriate rate. It might not need to be full market value, but it can't be market value from 20 years ago. Otherwise, you're going to be have a problem. Then there's the coverage B, which is your extended replacement coverage. Once again, that's other structures, your garage, your pergola, your gazebo, your whatever personal property, your house. Oh no, sorry, that's the next one.
These are things that people in California have.
Right. Your fence, Tim. You have a fence.
Yeah. Well, I guess we do. It's a wall, but yeah.
Okay. Whatever. If it somehow got destroyed by a fire, then you'd want to get that replaced, and fences are expensive. If you haven't priced out a fence recently, they're insane. So that's coverage B. Coverage C is your personal property, and it covers damage to, can you believe it, personal property. And so that's your, the stuff inside your house, your cars, your personal belongings, your diamonds, your cash, whatever. And so make sure that that is, if everything you own is secondhand, I speak from experience, you can probably not worry too much about, is that high enough? Because, well, as I look around here, the bed was purchased from the store new because I have standards. But I'm pretty easygoing outside of that as far as what, I don't need everything brand new from the highest, from Pottery Barn or whatever. So if, however, you are that person that wants new things from Pottery Barn, make sure your home is covered, your property inside your home is covered for your insurance, because it turns out refurnituring your house with Property Barn furniture after your home burns down or there's some type of event, expensive. So coverage D is additional living expense. So obviously if your house gets tented or whatever and you need to leave because of the termites or whatever, you might need to go live in a hotel for a month, or who knows. So make sure that that's covered with your policy as well. Coverage E, comprehensive personal liability. So this is one I do have some anecdotal experience with as well. A family that we knew when we lived in Utah, their son was rambunctious and they were over visiting other friends. And I think at one point he got the remote and chucked it directly at their big screen, brand new TV. And he had quite an arm. He plays baseball now. And so it just shattered the screen. And that was covered by the homeowner's insurance.
I think I saw that in a commercial once.
Yeah, you do see that in commercials, and this one I anecdotally know actually happened because once again I knew people to whom it happened. So that could be, that's one of the things that you don't always. I at the time didn't think I wouldn't have thought that was covered by any insurance, but that's your homeowners, depending on your policy.
It turns out their screen was not equipped with reverse 3D. See that? Yeah?
Okay.
I stretched a little far for that.
Okay. Yeah. Yeah. All right. Well, thank you, Tim, for the effort. Coverage F, medical expense covers. So that's medical expense. And that's obviously when somebody slips and falls on the stairs in your home and breaks a leg, and then they want to sue you or whatever, or just want to get covered, and that's how you would get that covered. So your homeowners covers things that happen inside your home, not just to your home. And so make sure you know what your policy looks like there. And once again, with and we didn't talk about this with health insurance, but your health insurance and your home insurance very frequently also have deductibles involved. health insurance can sometimes have co-pays instead of deductibles, meaning I don't have a deductible as in the amount of pay I have to before my insurance pays, but in order to go to see the doctor, I have to pay, be it $30 every time I go, independent of how much I've paid over the course of the life of the policy. Your homeowner's insurance will have a deductible, and set that to your risk level, your current financial situation, which once again we'll come back and talk to you a little bit later. But that is your homeowner's insurance. I have never made a claim on my homeowner's insurance. Tim, have you?
I have.
Oh yeah.
The tree in the front yard in a windstorm. Well, actually, it turns out a few windstorms over time. It blew the branches of the tree to rub against our roof, knocking a bunch of tiles loose, which fell and hit another part of the roof. And anyways, so I'm like, why are all these tiles on the ground? And finally figured it out. And so we had to pay our deductible, but then we got some coverage to replace the roof.
What I'd like to know, Tim, is I do know, and I hope most laymen listening already know, but if you don't, now you're going to learn it from a layman. When you make a claim on a policy, auto insurance policies are infamous for this, your rates go up. So did your rate go up on your homeowners after a claim?
Yeah, so it's kind of hard to tell because my home and auto insurance policy are bundled. And so I don't believe they did, though. I think most people can, if you've looked at your insurance rates over the past couple of years, you've surely seen them go up. Insurance rates, I believe, nationwide have risen quite substantially. And
That's
so,
true.
this was a couple of years ago, so it was right at the beginning of that process. So my rates have gone up, though I don't feel like it was because of that.
Okay.
But I will say this, just as a little addendum there, I called my insurance actually last week because I'd been looking at these rates going up, and I said, this is no good. And so I called them to see if there were ways I could get my payment to go down, the premium I'm paying. And so, and actually they worked with me and we looked through that stuff, and actually brought down the payment quite a bit. And one of the things was that they shifted to like a new like rating system. And so when they put me in the new rating system, it spat out a much um, lower premium. And so my advice to everyone listening is, if you do have like home insurance or car insurance, just call in every so often and just talk with them about, because they have different discounts they can put in. Our car insurance, they're actually having us do this thing where you download this app and it tracks your driving. And if you drive responsibly and carefully, then you can actually get a lower rate. And so there's ways to bring your costs down. Don't just assume that you're stuck with whatever rates you've got. If you'll just do a little bit of hustle and a little bit of advocating for yourself, you can often find uh, a, a way to improve your situation. So, anyways, for what it's worth.
Yeah. Well, you just took the end of the podcast, Tim. So
Dang it.
No, I have a couple other insights as well, but that is certainly one of them. So the things to consider, though, with homeowners insurance, like Tim was talking about, is the personal rates that you can get are affected by the choices that you're making as far as what your coverages you need. So, like I said, we're going to come back to that in just a minute, though. Final type of insurance I wanted to cover was renter's insurance. And so I know we have a bunch of people that listen to us that are in their, teens or 20s, and you might not own a home, but you might own something other than a car that you want to insure, and or all of your stuff together that you might want to insure. And that's going to be what a renter's policy is for. And those are usually pretty clear cut. They can have like a coverage maximum, and they're not usually super expensive. That is something, once again, you just need to consider what do you own? Is it worth insuring, and what is the tolerance you have for damage to those goods or loss of those goods. Okay, so those are the varieties of insurance and some of the basic coverages and ideas behind it. But let's talk briefly here at the end of the podcast about risk management, what affects the rates, and what you can do about your rates. Like Tim said, rates have increased significantly. And so what can you do about it? Well, this is all about, and insurance is all about risk management. Like we said from the beginning, your actuaries out there figuring out what risks these different policies pose to the company. So you need to be your own insurance actuary. You need to figure out what your own risk is and what rates make sense for you. So when you're buying auto insurance, if you are a student, do you need anything more than the basics? If you drive a clunker, do you need comprehensive and collision? Because do you really care if there's a dent in it? Maybe if it's destroyed, you care, so maybe you want a very high deductible plan where you're not paying much for that additional coverage, and you'd have to pay $1,000 out of pocket to get it fixed, but that's potentially manageable versus no coverage where you just have to buy a new car. Once again, figure out where you are in your financial picture and what kind of risk you can take on versus how much you're paying monthly for a relatively minimal risk. The likelihood that you are in a total loss accident where your vehicle is scrapped is low generally. So, but it's not impossible. So do you have the cash reserves on hand to buy a new clunker if you own a clunker? And if so, why are you paying for comprehensive and collision at all? Maybe you don't need it, because if you get into an accident, you'll just buy a new car, and the amount of money that you pay for the new vehicle will have been potentially less than you were paying for the policy the whole time. So consider those types of risk management assessments. Same thing for a life insurance. Like I said, I recommend term insurance. If you have a term policy and it goes for 20 years, and by the end of the 20 years, your dependents, your children or whatever, are out of the house, are they really relying on you having a large life insurance policy? So maybe you still want one, just a smaller one. Maybe you already have paid off your home, so there is no mortgage to cover for your spouse. So why have a large homeowner life insurance policy for that? So you can cut your term insurance down. Instead of paying for $500,000 of term insurance, maybe $100,000 would be sufficient. So once again, where you are in your life and where your financial situation is should affect these insurance decisions on a relatively frequent basis, annually at a minimum, right? And that's true about every coverage. Health insurance, homeowners insurance. With health insurance, you might think, well, that's not true. And like I said, this is for American listeners and or any other country that has private health insurance. Do you have enough for a high deductible, enough cash reserves on hand for a high deductible insurance policy? Meaning, I'm fine paying $3,500 out of pocket as long as my premiums are significantly lower, and the policy will still cover me in the case of some catastrophic incident. Because then, if my deductible is $3,500, but my monthly premium is $400 less a month, well, over the course of a year, I will almost certainly make that money back. Unless I'm at the doctor every day or whatever. So there are lots of different ways to assess your risk and the type of person you are, and the health that you have, or the type of car that you have, the life financial picture that you're in, the home risk that you have, and to using that calculate your rates and your deductibles and use those as the way that you lower the rates on your insurance. So some of the other things to consider when considering prices is location matters a huge amount for homeowners insurance, for car, auto insurance, health insurance probably as well, as far as what your cost is going to be. So if I move from Nebraska, rural Nebraska to downtown Los Angeles, you might know that, I'm going to pay a lot more for rent, but that's going to be fine. I get paid more. My job's going to pay me more. Okay, that's great, wonderful. But are you also aware that your car insurance is going to triple? That your, if you're just renting, obviously then your rental insurance might go up, but I don't know specifically about that. But if you own in Nebraska and then move to Los Angeles and buy there, your homeowner's insurance might also triple. Your health insurance costs might go up. Once again, it depends on a variety of factors, though. But the location of your car, the zip code that you're in, the location of your home are going to affect the rates. So consider that as well when looking at what job you're going to take, whether or not you want to move, to relocate, and use that calculus to figure out what rates you should be getting. Or you need to, how much you need to earn to counteract those rates. And then the age of everything is huge in insurance, right? My age for life insurance, my age for health insurance, the age of my car for auto insurance. When you're buying a new car, are you considering just the new car payment, or are you considering the fact that the car insurance is going to go from, to $150 a month to $250 a month? Are you considering the age of your home? And as your home ages, what's happening with the things inside your home? Do you need more coverage in order to cover a broken pipe, a roof that collapsed, something like that? So the age of a variety of the things of your resources and your life are going to affect the risk that you need to cover, and the amount that your insurance companies are going to need to charge you. Okay, last thing. What can you do about getting a cheaper policy, other than, like I said, just kind of assess it? Tim kind of already alluded to this, but you need to shop your policy. I mean, this isn't a Geico ad, but you need to spend some time, I recommend at least annually, looking through your policies. A few years ago, I was looking for a new homeowner's insurance policy, and I remember calling an insurance agent and telling them what I was currently paying, and they couldn't believe it. They said, "You're paying only that much?" They said, "You have an amazing policy," and I shop my policy frequently because the market is good. What the market is good for, and that's competition. And so you get out there, you say, "This is what I can offer." As far as the money I'm bringing to the table, because they want your policy premium, right? And they will have done their insurance calculations, their risk assessment, their actuary tables, but then you come there and then they have an incentive to try to get your business. And so independent of the actuary tables, if there might be a discount they can put on the table because they want to get you in with the expectation that you'll stay in. But if you then do stay in for a very long time without reassessing, maybe they're making the money back. The money that they kind of incentivized you in with, they're now drawing back over the term of your insurance policy with them. So don't be that person. Get the right rates for you. Get what insurance coverage you need by shopping the policy around. Buy cheaper things. I mean, the reality is it's going to cost a lot to insure your Ferrari. So maybe don't buy a Ferrari if you can't pay for it, if you can't pay for that higher insurance. Up your deductibles. Once you are no longer a student and $50 is no longer a large amount of money, go up your deductible. Like don't have a deductible on your car of $100. You're just paying too much in car insurance. Up your deductible to $500. Like I said, when I was in college, it's got to be lower. You just don't, sure, monthly it sucks to pay for that, but you just can't I didn't have an extra $200, every just at any moment to pay for a car issue. So you have to have a lower deductible and pay higher premiums because you're making money monthly, but on the drop of a hat, you might be out of money, right? So, um, so it's a vicious cycle when you're younger. But as you get into a more established job, up your deductible, lower those costs, it'll make a long-term difference. And yeah, that's the insurance insights that we have. So reassess this frequently, consider your coverages, and if you, like Tim, have paid off your home, good for you. But continue evaluating insurance needs. You will need these things throughout your life, and yeah, hopefully this has been useful. Like I said, internationally, this might be not quite as relevant, at least the health insurance and some of these other insurance policies and the way the market handles insurance might be different in the country that you live in. But the basic underlying principle of risk management for your own life is super important, and you need to be able to identify how you are going to manage that risk with savings and with insurance coverages. So take the time to do that. It'll get you on the right path. It'll get your loved ones and dependents on a good path forward, so that you're not stuck in a place where you don't want to be because you don't have the money to cover your catastrophic loss of a house or car or loved one, and you're just out of money, and nobody wants that. So we just talked about these coverages, and hopefully this layman, speaking to the layman out there, will help you identify some ways that you can kind of better manage all of that. So come back here again soon. We're going to talk about, I said, going to talk about chemistry, going to talk about, I think, fluid dynamics is what Matt promised at some time. So that's exciting, and we'll see you then.